Hello, and welcome to this new series of Accounting the Easy Way. We will cover a host of topics here, including all the concepts of financial accounting and managerial accounting. We start with part one of financial accounting, which is the financial statements. This particular presentation is totally theoretical based. Okay, so we are just starting with this chapter, and my agenda here is to make accounting as easy as possible for new accounting students. And even if you are, year one, year two, year three of your accounting undergrad degree, okay, this will um, basically make very easy for you to understand some of the concepts which you might feel a little confusing. So, what should you expect from this series? Okay, what we will expect is we will go in detail about theoretical accounting. Okay, so we're gonna go discuss accounting theory. We're gonna have examples on Excel worksheets, and then at the end of my presentations, I'm going to be posting some practice questions, which you can take it as homework. Okay. And at the same time, I will also be posting the answers. So once you're done with the homework, obviously without looking at the answers, you can always come back and match your answers and look for any explanations. Part one, learning outcomes. Okay. Once I'm done with this presentation, you will be able to explain why is accounting the language of business. And you will also be able to describe the purpose of each financial statement and explain its elements. And please keep in mind, this is just, the most basic of accounting theory. We are just starting. So I'm going to try to make it as easy for you as possible and try to use as easy language that will be, good enough for anyone to understand. In part two, we will take the next step and we are going to be explaining the relationships among these financial statements that we are going to discuss today. We'll describe the common accounts we use. We will get into a little bit of detail about transactions and what kind of effect those transactions have on the accounting equation. And towards the final part of part two, we will analyze the business transactions using the accounts. Language of business. Accounting is the language of business. Now we can have as much theory about this as possible. We open any book, okay, every book has a different way of explaining, okay, why is accounting the language of business? But just to make it as easy, think about it. In business, you have to make decisions. In order for you to make those decisions that will be profitable for the business, you have to analyze numbers on top of many other factors of, obviously there are other factors like customer service and things like that, but that is separate. Okay, in terms of accounting, you have to analyze numbers. You have to understand how to record those activities properly. Once you record them, you have to make sure that they are presented properly as reports. And then what you have to do, you have to present those reports to your stakeholders, people who invest in your business, to banks maybe because you take loans, and to your management. Obviously, management is a big stakeholder. Now, once we present these reports, okay, it makes us better equipped to make the right decisions. Why? It's because we are able to now understand how is this business performing, okay, in terms of, if I were to ask you, okay, what is one of the most important thing that owners are always focused on? That will be a profit. Owners want more profit. And in order for them to make more profit, they have to improve their revenue inflow. Revenue is the money that's coming in. We're gonna discuss that, in one of the slides in this PowerPoint. But long story short, once you are able to understand all these activities, reports, numbers, you start making better decisions. When you start making better decisions, your stakeholders are happy. So that is basically why we call this language of business. Okay. When you are presenting reports, you're talking about numbers, right? That becomes your language. Okay, so that is basically accounting is the language of business. And again, this was a very informal way of me telling you. You know, there's always obviously a lot of theory out there, any book you open, but that was a very informal way for me to explain this. Now, in terms of financial statements, when you have to present financial statements, first you understand how many financial statements we have to talk about. In the most basic way, we have our income statement, which is also called the profit and loss statement. We have our statement of retained earnings. What is retained earnings? Retained earnings is the money or the profit that you retain in the business. In other words, the profit that you do not distribute to your shareholders. Then you have the statement of cash flow, also called the cash flow statement, and you have your balance sheet, also known as the statement of financial position. How does the information flow? Your staff, including the management, makes decisions on a daily basis, obviously. Then they involve in business transactions. And once they involve in business transactions, those business transactions are reported as the final results. Now, going back to our income statement. Income statement is also called profit and loss statement. Okay? It reports your income, which is basically your revenues and gains, and it reports your expenses and losses. Towards the last part of the income statement, the last line is called the bottom line. And that is your net income or net loss for the period. Now, the reason why that is called bottom line is because there is nothing that goes or follows net income. Net income is the last part of the financial statement. And net income is basically all your revenues minus all your expenses. It is basically, in other words, think about the money that the owners want to take home, right? That is your net income. Okay, one of the most important part of the financial statement. I'm sure you have heard about bottom line many times. Okay, and if you ever hear bottom line again, know that they are talking about your net income. Okay, now let's get into a little bit more detail about revenues, gains, and expenses. Okay, imagine that you have a restaurant. And when you sell your products, which will be basically your food, okay, or your menu, okay, whatever you're selling, okay, it could be that you are freshly preparing your menu, or it could be that, your restaurant, you just sell packaged, ready-to-eat meals. It could be anything. Once you sell that, that becomes your revenue because that is your primary business. Whenever you engage in your primary business, it could be selling your products or performing a service. The money that you earn by doing that is called your revenue. Gains. In the most easy form, just imagine in the same restaurant, you have furniture. Okay, and at some point of time you want to replace that furniture with newer furniture. So what do? You try to sell it. Now when you sell the furniture, you are able to sell it for more money than what you paid for. That extra money is your gain. And obviously, it's not just furniture. There are a lot of examples. Okay, you can sell your truck, you can sell your building, you can sell your equipment, you can sell your furniture, as I said, anything. Any asset that you sell for more than what it was originally worth is going to be your gain. Expenses are basically the costs that you incurred in basically the normal course of business. And losses, think of selling the same assets that we spoke about before, like your truck, building, equipment, furniture, for less than what you paid for. That becomes your loss. So this is how an income statement looks like as an example. Okay, this is a very consolidated statement, meaning that we are not getting into too much details over here. And I can assure you, if you look at an income statement of a business, it's much more than this, but we are just trying to give an example and make a point. Okay, so you start with your net sales, which basically is your revenue. After that, you subtract your cost of goods sold. Cost of goods sold is the cost of the products that you're selling. In our example, if you have a restaurant and you decide to sell a pizza for $20, and let us say, for example, it costs you $10 to make that pizza. So your revenue will be $20. Your cost of goods sold for that one pizza is going to be $10, and your gross profit is going to be $10. Obviously, 20 minus 10. That is your gross profit. After the gross profit, you need to deduct all your other operating expenses. And some of the examples you can see on this slide. Okay, so selling, general, and administration. For example, you are paying sales commission to somebody. Okay, you are having somebody do your payroll, so you are paying payroll fees or cost. Okay, you are paying salaries to your management. Okay, it could be that you have taken a loan for the restaurant, so you have to pay the interest. What about your utilities? Heat, hydro, water, insurance. See, all those expenses are going to come now. And once you subtract all of that, you subtract your income tax and you report your net income. And again, please understand, it's very consolidated part. Okay, income statements are much more detailed. Okay, but basically, this is the information that you can expect to find from an income statement. Statement of retained earnings. So the net profit that we just spoke about, the shareholders or the board of directors have some options. Number one option is to retain that money in the business. It could be that you need money to invest into new technologies. Maybe you want to buy a new building, you want to buy new automobiles. Or what you can think is you can just distribute that profit to your shareholders. When you distribute that profit to shareholders, that is called dividends. So statement of retained earnings will show you that. How much was the net profit? How much of that profit you are retaining in the business after you subtract the dividends, after you decide and distribute the profit to your shareholders. Okay. Your statement of retained earnings will open with an opening balance. That balance is basically all the profit that you have retained from the previous years. If it is a new business, then obviously you will have a zero opening balance. After that, you add your net income, then you subtract your dividends, and what results is your ending retained earnings balance. And this is how that statement will look like in its most basic and generic form. Okay, so you start with the opening balance, you add the net income, subtract your dividends, and you have your ending balance of retained earnings. Obviously, if you did not earn a net income, and obviously, if it was a loss, then you're going to see a negative balance here. Instead of net income, you're going to have a net loss. Okay, but again, that is getting into more details, and we will cover that into the retained earnings chapter when we talk about the specific part. Okay, this specific part, we will be talking about shareholders' equity then when we will talk about those kind of detailed examples. The next financial statement is your balance sheet. Again, called statement of financial position. The reason why it's called the statement of financial position is because it tells you the condition of business at one specific point of time. Now imagine the income statement and the statement of retained earnings. Those statements are basically telling you how the business performed for the entire period. But the balance sheet is telling you the position at a specific point of time. That's the reason it's called specific statement of financial position. Now, what does this report? It reports your assets, liabilities, and owner's equity. And one of the most important points is that the balance sheet follows the accounting equation. And accounting equation is given in these brackets. It is assets is equal to the sum of liabilities and owner's equity. Okay. And you will see that the ending retained earning balance that we just spoke about a little while ago, that shows up in your owner's equity session. Now, if you are a new accounting student, questions that should be coming to your mind is, okay, what is an asset? What's a liability? What's owner's equity? And again, I'm going to tell you the same thing. You open so many books and you will find those kind of formal definitions, okay, with little variations. But in the most basic form, okay, asset. It is something that you control. It's a resource that you control, something that you own that helps you generate cash. It helps you make money. That is your asset. I will say again, something that you own or control, an economic resource that helps you generate income. Okay. Examples: your building, your land, your machinery, furniture, your truck, your shuttle, bus, anything. That is your asset. Two kinds of assets. One is current asset, another is long-term asset. Current asset is an asset that you are expecting or planning to convert into cash within 1 year or less. Within 1 year or less. Simple. And long-term assets are those assets which you are not planning to convert into cash within 1 year, and you are just planning to hold them for much more longer period of time. Examples of current assets. The best example is cash, because it is cash itself. There is no need to convert cash into anything further that is cash. It's cash itself. Then you have cash equivalents, some assets that are as good as cash. Example is your short-term investments. For example, you invest in bonds, short-term investments, okay, three-month bond, 6-month bond, okay, or you have invested in highly liquid equities that you can sell at a moment's notice. That becomes your current asset. There are other examples as well. Okay, and we're going to talk about them. Long-term assets, you have your examples on the screen. You have your land, buildings, computer equipment, okay, long-term investments and things like that. Some of the other assets, we are talking about current asset, is your accounts receivable, inventory. Okay, why inventory? Because obviously you want to sell inventory as soon as possible because you want to make money. So let us say again, going back to the restaurant example. You have all the raw materials. Your agenda is to convert those raw materials into finished goods so you can sell and obviously make your revenue. So inventory becomes your current asset, something that you plan to convert into cash within 1 year. Accounts receivable. This is the money that people owe you. So you sell your products. Not all the customers pay cash. Some customers are on credit or they are on account. So instead of paying you cash, they might have a contract with you that they will pay you within 2 weeks or within a month. That becomes your accounts receivable. And your prepaid expenses. Okay, example of prepaid expenses is like you're paying for rent. Okay, let us say your landlord tells you that if you were to pay 3 months advance rent, you might get a 10% discount. To avail that discount, you pay 3 months advance rent. That payment becomes your asset, and that asset is called your prepaid rent asset. It's a current asset. Why it's a current asset? It's because you can use that asset in the short term to make money. Because you need to pay rent to run your restaurant, and you're running a restaurant to make money. So you're using that rent to run your business to make money. That's why when I said you plan to convert these into cash within 1 year or less. Now we talk about liabilities. Assets are your resources that you control that help you make money, that you own. Liabilities are the economic resources that you owe to somebody else. Okay, so assets you own, liabilities you owe. Two kinds of liabilities, just like assets. Current liabilities, those are the liabilities that you have to pay within 1 year or less. And long-term liabilities that you will pay after 1 year. Examples in current liabilities is accounts payable. This is one of the easiest examples. And what accounts payable is, let us say you buy raw materials from your supplier. For your restaurant, you bought raw materials, okay? Like you bought vegetables, meat, eggs, milk, bread, okay, flour. And when you buy those raw materials, you have to pay for them. And mostly when you have those kind of big orders, you don't pay cash. It's not feasible all the time to pay cash, right? So businesses have accounts, meaning you will pay at a later date. So you get the delivery, and now your supplier is going to send you an invoice with a date of payment, and you pay at that on that date. That particular amount that you are liable to pay is your current liability. Why? Is because immediate payment is required on that due date within 1 year. Usually those payments are required within 1 month, but they satisfy the definition of a current liability. Means that you have to immediately make those kind of payments. And then there are obviously other examples like your salary. You have to pay salary to your management. You have to pay wages to your staff. Okay, you have to pay your utility bills. You have to pay your rents. You have to pay for your insurance. So all your current liabilities. Long-term liabilities are liabilities which you're gonna pay at a later date that's more than a year from now. Okay, there are many examples. Okay, like let us say you have to pay for bonds. Okay, people invested in your business, you have to pay for their interest payments after 1 year, or you are paying for a mortgage. Okay, so anything that you have to pay after 1 year is all coming in your long-term liabilities. And again, when time comes to talk about these concepts, we will get into more details. Owner's equity. Okay, this is what the owners own in that business. Simple way to calculate is you take your assets, subtract your liabilities. You take your assets, subtract all the liabilities. Whatever is remaining, it is owner's equity, means owners own that. Okay, it consists of the common shares, it consists of retained earnings, which was all the profit that the business is retaining in the business. Something that is not distributed to the shareholders, something they are retaining in the business is your owner's equity. I will say again, easy way to calculate owner's equity is your assets minus liabilities. It is what owners own in that business. Ownership of your net assets. And why we call them net assets is because assets minus liabilities is your net assets. Whatever assets are remaining after you clear off all your liabilities. That becomes your owner's equity. One of the easiest examples is your mortgage. Let us say you bought a building for $100,000. You bought a building for $100,000. Out of $100,000, $50,000 you still owe to the bank as part of your mortgage. So what is your share of equity in the building now? Let us say if you were to sell that building, let us say for this example, we are not considering any kind of capital appreciation. Means we are not considering that you're going to be selling the building for more than $100,000, because mostly that is the case. But just to make this easy, you have a $100,000 building that you purchase for your business. Okay, already you have paid for $50,000. You just owe half of that amount. If you were to sell this building for $100,000, $50,000 is going to the bank because that is your liability. You have to pay the bank. What is left is $50,000. That becomes your equity. Okay, so that is one basic simple example of owner's equity. This is how a sample balance sheet looks like. Okay, you have all the assets on the left side and your liabilities and shareholders equity on the right side. And again, shareholders equity, you can call owner's equity as well. It's the same thing. So there is no need to get confused with those kind of terms. Okay, so same thing. Okay, so you take your assets, those assets, the total assets should be equal to the sum of liabilities and owner's equity. As long as your assets are equal to liabilities and owner's equity, that tells you that your balance sheet is balanced and your calculations are correct. Most of the times, there could be some exceptions in which you have made an error, but still it is somehow balancing, and we're going to talk about those errors also. But that does not happen for, most of the times your calculations are correct if your balance sheet is balanced. And that is one of the reasons why we call this statement, this financial statement, as balance sheet, because we are talking about balancing both the sides. Left side should equal to the right side. We talk about the statement of cash flows. This is the last statement that we are going to be talking about in this class. Statement of cash flows. You know, income statement talks about the revenue. Okay. But imagine not all the revenue is coming in cash. And I gave you the reason before, because not all the customers pay in cash. Some of them have a contract. They say, well, we're going to pay you at a later date. But statement of cash flow only focuses on cash. It has nothing to do with anything else. Statement of cash flow will tell you basic, in the most basic sense, what it will tell you is how much cash came in your business and how much cash went out of your business. In other words, did your cash balance increased or decreased? So whatever your cash receipts are, you will see in the cash flow as an increase. And whatever your payments are, you're going to see as a decrease. Your ending cash balance is going to your balance sheet. Okay. There are three kinds of activities. There are three kinds of activities reported on your cash flow statement: operating, investing, and financing activities. This slide tells you what they are. Operating activities is coming from your primary business source. Okay, it's coming from the receipts and payments from selling your goods and services. So your primary business activities. Number second is your investing activities. Investing activities is purchasing and selling of long-term assets. If you buy a building, you have to pay cash. So cash went out of your business. If you sell a building, cash came back in. That will be recorded in your investing activities. Financing activities. Let us say you issue shares. You got a loan. People are investing in your business. You're paying out dividends. You're paying out the share, you're paying it out, your net profit to your shareholders. All going to come in financing activities. At the end of the day, all these financial statements, so we're talking about your profit and loss statement or your income statement, talking about your statement of retained earnings, and talking about the cash flow statement. All of these statements will ultimately, the information is going to flow to the balance sheet. I will say again, all the information from these statements in one form or the other will always flow to the balance sheet. And that is the reason why balance sheet is called the mother of all financial statements. Okay. In terms of your cash flow statement, let us say if I were to ask you a question, out of these three activities, which one is the most important? Okay. So cash is coming in from three different parts. One is your operating part, investing, and financing part. Which is the most important? If your answer is operating activity, you are absolutely correct. Most of the cash that's coming to your business, a healthy business, must come from operating activity. Because if it is coming from investing activities, what that means is that you're selling off your assets. And why would somebody sell off their assets? Okay. Why would somebody sell off? Okay. It opens box of questions. Okay. It opens, makes you think 100 things. Okay. Why is somebody selling off their assets? What's going on? Are they genuinely interested to improve, or they are just selling off the assets just because the business is not doing that good and they really need cash? Because remember, cash is very important. You have to pay your bills on time. Okay. So when we are assessing a business, we have to make sure that we look at all these statements in relation to each other. We can never make decision just by looking at one statement. And again, part 2 of the series, we're going to come with some examples where we are going to talk about these concepts in a little bit more detail. That brings us to the end of part 1. Thank you for watching. My next video will cover relationships among various statements, common types of accounts, impacts of transactions on the accounting equation, and DT accounts. In the comment section below, please let me know what other topics you would like me to explain to make learning easy for you. Thank you.